In this video, we will talk about the rising number of foreclosures. Hi, my name is Mac Rogers. I'm a real estate broker here in the San Francisco Bay Area. Welcome back to the channel. In the news lately, we've been flooded by all the impending housing market crash. No doubt you've seen headlines like this. Homeowners have lost 1.5 trillion in equity since May. That's trillion with the T. Everyone knows that during the pandemic or the last 2 years, home values have just skyrocketed, and this is already on top of home values increasing every year since before 2020. Well, you know what they say, right? What goes up must come down. And since May of this year, according to Black Knight, a mortgage software analytics company, homeowners have lost about 1.5 trillion in equity, or just about 30,000 for the average borrower. Before this, we've had around 17.6 trillion in equity, which was the peak. This was due in large part because of home prices jumped around 45% since the start of the pandemic. Black Knight's latest report, which is around the end of September, shows that we are still up by 41%. So there's still a ton of equity for those who bought a home before the pandemic. That roughly translates to around 92,000 in equity per borrower. According to Black Knight, additional declines may be on the horizon. I think they're hedging their bets because by now, everyone knows that declines are bound to continue. We know that home prices have weakened ever since the Feds starting raising rates one after the other. It's not an exaggeration to say that most home buyers today are paying double just to be able to afford a house. And this is why home sales and home prices have been going down. In the case of the number of transactions, that's significantly down. Home prices have been falling on a month-to-month basis, but still up when compared to last year. In fact, for 3 or 4 months in a row now, we've seen home prices going down. There's also a seasonality component to this, but for this year, 2022, it was down sharply than usual. According to a CNBC article, prices now are down 2.6 since the end of June, which is the first 3-month drop since late 2018 and the steepest such drop since the financial crisis early 2009. Since July, the median home price is down by 11,560. Prices, however, are still 10.7% higher than they were in September of 2021. This decline directly correlates to what is called as tappable equity. What is tappable equity? Well, I'm glad you asked. It's the amount of collective equity available to borrowers while still keeping 20% equity in the homes. This is the first decline in 3 years. Take a look at this graph for perspective. That's what it means when they say there's a drop in tappable equity. When you look at it or just hear about it, it's true, the drop is huge, but the other side of that is that it's still higher by 400 billion when compared to last year. And when you compare it prior to the pandemic in 2019, we're not even close to dropping to that level. What I'm trying to say here is that while it's true we've lost 1.5 trillion in equity, when you look at the overall picture, it's still strong or good in terms of equity in homes. In fact, this is one of the shining stars, if you will, of what's going on the market. These high equity levels could be the cushion that stops us from full-blown foreclosure crisis, just like in 2008. But it's not all good. With inflation rising, interest rates rising, guess what else is starting to rise? Consumer or household debt is surging. In fact, it's growing the fastest pace in 15 years. We are back to 2019 levels according to the Feds. Now, I don't really know if going back to those levels are bad, but most likely this surge in credit card debt or usage is because people are needing to bridge the gap with their income and spending. Which brings us to mortgages. Right now, the number of borrowers or homeowners that have negative equity is still low, less than 1%. But just like credit card debt, that number is on the rise. I'd say that mortgage debt is not an issue right now when you look at debt to income ratio of the borrower. In fact, we are still at historic lows. This is primarily driven by the fact that a majority of homeowners have very low mortgage rates right now. With this rapid shift that's happened in the housing market this year, obviously some people are raising concern that we're destined for a repeat of the crash we saw in 2008. But in truth, there are many key differences between what's happening today and the bubble of the early 2000s. One of the reasons this isn't like the last time is the number of foreclosures in the market is much lower now. Here's a look at why there won't be a wave of foreclosures flooding the market. Not many homeowners are in trouble this time. After the last housing crash, over 9 million households lost their homes due to foreclosure, short sale, or because they gave it back to the bank. This was in large part because of more relaxed lending standards where people could take out mortgages they ultimately couldn't afford. Those lending practices led to a wave of distressed properties which made their way into the market and caused home values to plummet. But today, revised lending standards have led to more qualified buyers. As a result, there are fewer homeowners who are behind on their mortgages. As one vice president for the MBA says, for the second quarter in a row, the mortgage delinquency rate fell to its lowest level since the MBA survey began in 1979, declining to 3.45%. Foreclosure starts and loans in the process of foreclosure also dropped in the third quarter to levels further below their historical averages. There have been fewer foreclosures over the last 2 years. While you may have seen recent stories about the number of foreclosures rising today, again, I say keep that in context. During the pandemic, many homeowners were able to pause their mortgage payments using the forbearance program. The program gave homeowners facing difficulties extra time to get their finances in order and in many cases work out a plan with their lender. With that program, many were concerned it would result in a wave of foreclosures coming to the market. That fear didn't materialize. Data from the New York Fed shows there are still fewer foreclosures happening today than before the pandemic. That means while there are more foreclosures now compared to last year when foreclosures were paused, it's only logical that we get a surge after a pause, right? The number is still well below what the housing market has seen in a more typical year like 2017 to 2019. And most importantly, the number we're seeing now is still far below the numbers we saw during the market crash. Check out the graph here. Take a look at the red bars. The big takeaway, don't let a headline in the news mislead you. While foreclosures are up year over year, historical context is essential to understanding the full picture. Most homeowners have more than enough equity to sell their homes. Many homeowners today have enough equity to sell their homes instead of facing foreclosure. Due to rapidly rising home prices over the last 2 years, the average homeowner has gained record amounts of equity in their home. And if they've stayed in their homes even longer, they may have even more equity than they realize. Again, from an economist from First American, homeowners have very high levels of tappable home equity today, providing a cushion to withstand potential price declines, but also preventing housing distress from turning into a foreclosure. The result will more likely be a trickle than a tsunami. A recent report from Atom Data explains it by going even further into the numbers. Only about 214,000 homeowners were facing possible foreclosures in the second quarter of 2022, or just 0.4% of the 58 million outstanding mortgages in the US. Of those facing foreclosures, about 195,000 or 91% had at least some equity built up in their homes. Currently, there's less than 500,000 borrowers that are underwater on their mortgages, but that is still double than what it was in May. The risk here is that we continue on the path of prolonged recession and more layoffs. This most likely will further erode home equity that's been built up. And when we get to the stage where the people that bought a home in the past 2 or 3 years starts getting affected or starts losing their jobs, they're the ones that are more at risk of going underwater. Look, the bottom line is this. If you see headlines about increasing number of foreclosures today, remember context is important. While it's true the number of foreclosures is higher now than it was last year, foreclosures are still way below pre-pandemic levels. Hey, thanks for watching. Have a great day.